Have you ever looked at your savings and quietly wondered how fast your money could realistically grow without gambling? Many people assume investing success is about timing markets, but most long-term wealth actually comes from patient compounding. Today, we are not chasing hype or shortcuts. We are answering one clear question using real numbers and logic. If you had $1 million ready to invest today, how long would it take to realistically become $2 million? I am Max, and my goal is to break down complex financial ideas into simple stories anyone can understand. Before we begin, gently tap. Like if you want calm, realistic money conversations without pressure or exaggerated promises. That small action helps this video reach people who care about long-term wealth, not overnight success fantasies. If you enjoy learning how money actually grows over time, consider subscribing so you never miss future videos. And leave a comment sharing your age range because investing decisions feel very different at different stages of life. You can also share this video with someone who wants clarity about investing but feels overwhelmed by conflicting advice. In this video, we are walking through 5 Vanguard index funds ranked by how fast they could double $1 million. We will start with the slowest and most stable option, then gradually move toward faster and more aggressive strategies. For each fund, I will explain what it owns, how it grows, and how long compounding realistically takes. These are not guesses or predictions, but long-term historical averages from reliable sources and fund reports. All numbers are based on dividends being reinvested in the investment sitting inside a tax-advantaged account. No additional money is added because we want a clean comparison using the same starting point. $1 million stays $1 million until compounding itself does the work. Index funds often get grouped together, but they behave very differently depending on their structure and focus. Some funds prioritize stability and smoother returns, while others intentionally push growth at the cost of volatility. Understanding these differences is what separates patient investors from frustrated ones who constantly second-guess. The 5 funds in this video were selected based on growth potential, income behavior, and historical compounding speed. I am not telling you which fund you should choose because the right answer depends on your tolerance for stress. Instead, I want you to clearly see the trade-offs before you ever commit your money. Speed in investing always comes with a cost, and that cost usually shows up emotionally during market downturns. As we move through each fund, pay attention not only to returns, but also to the journey required. A faster portfolio is meaningless if you cannot stay invested long enough to benefit from it. We will begin with the most hands-off and conservative option on this list. This fund is designed for people who want simplicity, automation, and minimal decision-making. It is not built to impress or excite, but to quietly do its job over decades. This is the Vanguard Target Retirement 2060 Fund, often chosen by investors who value peace of mind. Inside this fund, your money is spread across U.S. stocks, international stocks, and bonds. Early on, stocks drive most of the growth, but bonds are always present to reduce volatility. As time passes, the fund automatically shifts toward bonds to protect investors nearing retirement. This automatic adjustment is called a glide path, and it slowly lowers risk as years pass. That glide path makes investing feel easier, but it also limits how fast money can grow. The dividend yield provides steady income, but income is not the primary growth engine here. Most of the long-term growth comes from gradual price appreciation rather than aggressive expansion. Historically, this balanced approach has produced consistent but patient returns. If Max invests $1 million here, the first year sets a realistic tone. The portfolio grows steadily, but nothing about the progress feels dramatic or exciting. Over several years, compounding quietly builds momentum without large swings in account value. Around year 7, the portfolio begins approaching the $2 million milestone. In year 8, the account finally crosses that line, doubling through consistency rather than speed. This fund rewards discipline, patience, and emotional stability more than bold decision-making. It is the slowest option on this list, but also the least stressful for most investors. After seeing this timeline, a natural question starts forming in many minds. What happens if we remove bonds and focus entirely on stocks that actually drive growth? That single change dramatically alters the speed of compounding and the emotional experience. And that question leads us directly to the next fund on our list. This is where the strategy begins shifting from comfort toward faster long-term growth. Removing bonds changes the entire equation because stocks are the primary engine that truly drives long-term wealth creation. When bonds disappear, investors accept higher volatility in exchange for stronger expected growth over extended periods. This trade-off marks a clear shift in strategy and brings us to the 4th fund on this list. The 4th fund is the Vanguard Total U.S. Stock Market Index. designed to represent the entire American economy. Instead of selecting winners, this fund owns large corporations, mid-sized businesses, and smaller companies together. As companies grow, their influence increases naturally, and when they shrink, their weight gradually declines. There is no active decision-making involved, only the market constantly rebalancing itself through price movement. This structure keeps investors fully exposed to whichever sectors and companies are performing best at any moment. Compared to the retirement fund, this approach removes stability features but significantly increases compounding speed. Dividend income also becomes more meaningful here, quietly adding fuel to long-term portfolio growth. Dividend yields are higher, and dividend growth has historically been stronger than balanced retirement-focused funds. When dividends are reinvested, they continuously purchase additional shares during both market highs and downturns. Price appreciation remains the main driver, but dividends accelerate momentum earlier within the compounding timeline. Historically, the total market has delivered solid long-term returns through full equity exposure. This fund does not attempt to be defensive or predictive. It simply reflects the market itself. If I invest $1 million into this fund, the first year already looks noticeably different. The portfolio grows faster as stronger price movement spreads across the entire stock market. Over 5 years, compounding becomes clearly visible as gains stack upon previous gains. Reinvested dividends quietly contribute meaningful value without requiring any additional action or decisions. By year 6, the account stands significantly closer to doubling than the retirement fund ever achieved. In year 7, the portfolio crosses the $2 million milestone through full market participation. That single-year difference may sound small, but it represents 12 months of regained time. This demonstrates the power of removing bonds and allowing equities to operate without restriction. However, faster growth also introduces sharper declines during market corrections and economic uncertainty. Investors must emotionally tolerate larger swings without panicking or abandoning their strategy. This fund rewards discipline more than intelligence because the approach itself remains extremely simple. Many investors fail here not due to poor returns, but because emotions disrupt consistency. After observing this improvement, another important question naturally forms in Max's mind. If owning the entire market reduces time, what happens when we focus only on dominant leaders? That thought moves the strategy toward concentration rather than broad diversification. Instead of thousands of companies, the next fund focuses on America's strongest and largest businesses. These companies possess proven profitability, massive scale, and lasting influence across the global economy. This shift intentionally sacrifices diversification in exchange for potentially faster long-term growth. Over extended periods, large cap leaders have often outperformed the broader market averages. That outperformance is never guaranteed, but historical data reveals a consistent long-term pattern. Investors choosing this path deliberately narrow exposure to increase speed and efficiency. This approach feels more aggressive, yet it remains rules-based and disciplined. There is still no guessing involved, only systematic exposure to proven market leaders. The index automatically increases weight toward companies already demonstrating strong performance. That concentrated focus explains why the next fund accelerates compounding even further. It also explains why volatility becomes more noticeable during difficult market periods. Faster progress demands stronger emotional control and long-term commitment from investors. The reward for enduring discomfort is a meaningfully shorter timeline to major financial milestones. At this stage, excitement and fear often appear together within the investor's decision-making. Understanding that emotional tension is just as important as understanding numerical returns. Speed without emotional discipline often results in poor decisions at the worst possible moments. With that awareness, it is time to examine the third fund on this list. This fund is widely recognized, frequently discussed, and deeply influential within investing culture. It represents a decisive shift toward concentrated leadership and faster wealth compounding. This brings us directly to the Vanguard 500 Index Fund. The Vanguard 500 Index Fund focuses exclusively on the largest and most consistently profitable companies in the United States. Rather than owning every business, this fund intentionally concentrates capital on companies already dominating their respective industries. These companies generate enormous revenues, strong cash flows, and resilient profits across multiple economic cycles. When one company outperforms others, its weighting inside the index automatically increases without human decision-making. That structure rewards success, allowing market leaders to compound influence and capital allocation over time. This built-in momentum explains why the S&P 500 has historically grown faster than broader market indexes. Compared to total market exposure, diversification decreases slightly while growth efficiency often improves meaningfully. Dividend income still exists, but dividends play a supporting role rather than driving overall portfolio growth. Large established companies often reinvest profits internally instead of aggressively increasing dividend payments. As a result, dividend yields appear lower while price appreciation becomes the dominant long-term growth engine. Historically, price growth within this fund has exceeded broader market averages across long-time horizons. That stronger appreciation significantly compresses the number of years required to double invested capital. If I invest $1 million into this fund, acceleration becomes visible surprisingly early. After the first year, the portfolio grows noticeably as leading companies continue expanding market share. By year 3, compounding momentum clearly surpasses what the total market fund typically delivers. Gains now stack on top of already larger balances, increasing growth speed naturally. Around year 5, the portfolio moves within striking distance of the $2 million milestone. In year 6, the account crosses $2 million, doubling faster than broader diversification strategies. That 1-year difference may seem small, but it represents meaningful time reclaimed over an investing lifetime. This fund rewards patience combined with trust in proven corporate leadership and long-term dominance. However, increased concentration introduces risks that investors must understand before committing emotionally. If major companies struggle simultaneously, portfolio declines can feel heavier than expected. Even famous household names experience deep drawdowns during extended market stress periods. Emotional discipline remains critical because brand recognition does not eliminate volatility or fear. Many investors overestimate their tolerance for losses during prolonged market downturns. Those who remain invested often benefit from strong recoveries, driven by corporate scale and profitability. The S&P 500 occupies a middle ground between speed and diversification. It grows faster than owning everything, yet feels calmer than extreme growth-focused strategies. For many investors, this balance feels both logical and emotionally manageable. Still, Max continues questioning whether the timeline can be shortened even further. If concentrating on leaders reduces years, what happens when growth becomes the sole objective? That question pushes the strategy away from income and stability entirely. Growth-focused funds intentionally prioritize expansion over dividends, predictability, and emotional comfort. These strategies magnify gains during strong markets and deepen losses during downturns. Investors choosing this path must accept sharper emotional swings without abandoning discipline. The reward for accepting that emotional discomfort is a dramatically shorter path toward doubling invested capital. At this point, the difference between 6 years and 5 years becomes far more meaningful than most investors expect. One additional year represents time, opportunities, and emotional energy that cannot be recovered once lost. Speed now overtakes diversification as the dominant factor shaping portfolio construction decisions. This mental shift marks a turning point in how Max evaluates risk, reward, and long-term priorities. See, the strategy now moves decisively away from balance and directly toward maximum growth acceleration. Income gradually fades into the background as capital appreciation becomes the primary objective. Comfort and predictability are intentionally exchanged for momentum and higher expected long-term returns. This approach appeals to investors who value speed more than smooth emotional investing experiences. It also exposes portfolios to periods of sharper volatility and more intense market drawdowns. Understanding and accepting that trade-off is essential before committing to faster growth strategies. With those realities clearly acknowledged, we can now examine the second fastest fund available. This fund is designed for growth first, with income and stability treated as secondary considerations. It represents a clear departure from traditional balanced investing philosophies and expectations. This transition brings us directly to the Vanguard Megacap Growth Index Fund. The Vanguard Megacap Growth Index Fund exists for one purpose: maximizing growth by concentrating on dominant growth-driven companies. This fund deliberately ignores balance, income, and comfort to pursue faster capital appreciation above everything else. Inside the portfolio are massive growth-focused businesses leading technology, innovation, and scalable digital platforms. These companies reinvest profits aggressively, prioritizing expansion instead of distributing cash to shareholders. As a result, dividend income becomes almost irrelevant within this growth-focused strategy. Dividend yields remain extremely low, reinforcing that income is not part of this fund's core objective. The real driver here is price appreciation, which has historically outpaced most diversified market strategies. Because the portfolio is more concentrated, each holding carries greater influence on overall performance. When these companies perform well, the portfolio accelerates rapidly and compounds gains much faster. However, when growth stalls, declines can feel sharper and emotionally more difficult to tolerate. This fund demands strong conviction and emotional discipline from investors during volatile market periods. If Max invests $1 million here, the acceleration becomes noticeable almost immediately. After the first year, the portfolio grows significantly, driven almost entirely by strong price appreciation. By year 3, compounding builds upon already large gains, increasing momentum at an accelerating pace. At this stage, the timeline to doubling capital shortens dramatically compared to broader market strategies. Around year 5, the portfolio surpasses $2 million, achieving the goal far sooner than expected. This rapid growth highlights the power of concentrated exposure to dominant growth companies. The trade-off remains clear. Greater speed comes with greater volatility and emotional pressure. Investors must honestly assess whether they can remain invested during inevitable sharp drawdowns. With that reality understood, one final question still remains about pushing speed even further. That final question leads Max toward the fastest and most aggressive option available among Vanguard index funds. This fund abandons diversification across sectors and focuses entirely on technology and innovation-driven companies. It is called the Vanguard Information Technology Index Fund, designed for maximum growth with minimal concern for comfort. Inside this fund are software platforms, semiconductor leaders, cloud infrastructure providers, and digital service giants. These businesses scale rapidly, allowing revenue to grow faster than costs across long periods of innovation. Because of that focus, income becomes almost non-existent within this portfolio structure. Dividend yields remain negligible, reinforcing that growth, not income, is the sole objective here. Historically, price appreciation within this fund has exceeded every other option on this list. That exceptional growth potential explains why this fund behaves so differently from diversified market strategies. If Max invests $1 million here, the impact becomes visible almost immediately. After the first year, the portfolio grows sharply, driven almost entirely by rapid price expansion. By year 2, compounding accelerates further as gains build on top of already strong returns. In year 3, momentum continues stacking, pushing the portfolio dramatically closer to doubling. By year 4, the account surpasses $2 million, reaching the goal faster than any other fund examined. This speed represents the most extreme example of concentrated growth-driven compounding. However, volatility here is significant and emotionally demanding during market downturns. Investors must tolerate sharp drawdowns without abandoning the strategy prematurely. Comparing all 5 funds reveals a very clear and important pattern. Slower funds prioritize stability, while faster funds demand emotional strength and patience through volatility. There is no universally perfect choice, only trade-offs between speed, comfort, and risk tolerance. The fastest fund is meaningless if you cannot remain invested during inevitable market stress. True investing success depends on matching strategy with personal temperament, not chasing maximum returns. Max's goal is not to impress, but to help viewers make decisions they can live with long-term. Doubling money faster feels exciting, but peace of mind often proves more valuable over decades. Understanding these trade-offs allows investors to choose intentionally rather than emotionally. If this breakdown helped clarify how compounding actually works, you are not alone. Many people struggle simply because nobody explains these ideas in plain language. If you found value here, gently tap like so this video reaches others seeking clarity. Subscribe for future videos where Max breaks down money decisions calmly and realistically. And share this video with someone who wants growth but also wants to sleep well at night.